All right, so chapter 4. Okay, it's going to introduce a new thing, which is a little contrived, to be honest. It's this closing process. That's kind of the new thing. Um, but before we get there, we will uh, kind of look in a little more detail to balance sheets. We've touched on a lot of these topics before, that like how the balance sheet is arranged. But we'll explicitly talk about this classified balance sheet in this chapter. Um, the accounting cycle, we've kind of been doing it. Okay, these first chapter 1 was kind of intro, but chapter 2 and 3 are parts of the accounting cycle. We're going to learn about kind of the last part of the accounting cycle and what it is. And this is basically going to give you an overview of what an accountant does, a, how a business kind of reports their financial statements. It's in a cycle. Okay, so we'll explicitly talk about what that is. Um, I think I mentioned this before in an earlier lecture, but permanent versus temporary accounts, and we'll see why that's useful. Again, it's a little contrived because I'm going to show you how an accounting software kind of handles this, and like this accounting software really doesn't have this differentiator between temporary and permanent because it has all your accounting records since the beginning of your company, and it can kind of just look at different windows of time. But for our purposes, just conceptually, we're going to talk about what these are. Um, this is kind of the new part of this, that the new concept in this chapter is the closing process. So, um, closing entries, we're going to talk about what those are. Again, like you'll never have to do this as an accountant. Okay, this is just a conceptual, contrived thing that you're going to do as part of your education in accounting, but you will probably never have to actually do this. Okay, it's just going to help you clarify what accounting periods are, what happens between periods, like what accounts kind of transfer over. So it will at least conceptually be helpful to understand what's going on. Um, and then we'll introduce this post-closing trial balance. Again, another contrived thing, which you'll probably never see. And then current ratio. This is our financial ratio that we'll talk about. Um, and then reversing entries. Now, if you ever work as like an accountant, this is actually something that you may see. Okay, so this last little ending topic, practically speaking, could be something that you're gonna deal with if you ever work as an accountant. Like if you have your own small business, or if you work as a bookkeeper, you'll probably see this thing called reversing entries. Okay, so um, this is a little review from the last chapter. We had this thing called the trial balance. Okay, and we had the unadjusted versus the adjusted. So what was the difference? What changed between the unadjusted and the adjusted trial balance? Does anyone want to share their thoughts? Now I got my seating chart here. So what about Wyatt? What do you think? What happened between the unadjusted trial balance and then the adjusted trial balance? What do we do that changed the balances? The Sorry, what? Okay. Uh, yeah. Well, what changed the balances, right? We had unadjusted balances. What do we do to change balances and then require us to kind of recompile all the balances? Yeah. What were those called? Like just those. There are types of journal entries. What do we call them? What was the name of chapter 3? Yeah. Yeah. Adjusting entries. Okay, so we had the unadjusted balances. We did all these adjusting entries for deferrals and accruals, right? That was the reason why we did them, but they're called adjusting entries. And then that we changed the balances, and we then had this recompilation called the adjusted trial balance. And this adjusted trial balance is arranged in a way that groups the accounts by what financial statements they're going to go on, right? So at the bottom, we had these income statement accounts. So you can see all the revenues and all the expenses are here. And then we added in dividends. So all these debits and credits kind of get netted together into retained earnings. And then we had all these other accounts, and then all these other accounts from the balance sheet. And then we also incorporated all this stuff into the retained earnings, which completes the balance sheet. Okay. So this is not just BS. Okay. This is actually how the accounting software works. Okay. So let me show you that. Okay. So this is again just some free accounting software. QuickBooks is going to be the same. You know, your enterprise level, you know, what a big company uses, it's going to be something similar to this. Okay, so if I go to this reports, this is a company. This, you know, actually, let me just show you this. So this is a company I just made up. Okay, hold on. Let me go to the different one. So I just have all these fake, these are all journal entries. Okay, I just made up a company and I just made a bunch of accounting entries as if the company is a real company. It has revenues, expenses, it's bought assets. This is just a list of all the different journal entries that have been entered into the accounting system, just like just like we did in chapter 2. Okay, um, and so if I go to this reports, they will have the trial balance. Okay, so it's exactly as we talked about. It has, and they're doing actually a little better job arranging things because it has the assets. You can see they're all debit balances. The liabilities. This is a debit balance. This is wrong. So we would want to see what is going on here. Um, your equity accounts, and I guess there is no revenue. Oh, it's because it's for old. Let's see. This is still wrong though. I wonder. Let's see if we can see what went on here. So let me fix this. I must have done this journal entry wrong. So this is, again, I guess this is kind of showing why this trial balance is useful. Okay. Um, archives review. 4/15/24. So let's go back to our transactions. 4/15/24. I don't have to go back. I don't know how to change this now. Let's see. Uh, edit. Okay, anyways, I'll fix this. Anyways, I just wanted to show this to you because really this trial balance is like a real thing, okay? And it helps you find problems. I just found a problem in my books, right? I'm gonna have to go back and figure out how to fix that. Okay, so you as an accountant will do all your journal entries. I saw that there's a mistake because I know liabilities should be a credit balance, right? We agree with that? So that's how you know, just reviewing this, I quickly was able to see a mistake. So, you know, this is the kind of stuff that a accountant is going to have to be familiar with. You should, you know, hopefully see a mistake like that and know that there's something that was entered incorrectly. Okay, so that's why this stuff is useful. Okay, so but again, you can see that it's all arranged by kind of what financial statement it's going to go on. Okay, again, so the equity accounts, I don't have any revenue or expenses. listed here, and I did this like a couple weeks ago, so I gotta go review exactly. Oh, okay, here we go. So there is some income. It's just the period I was looking at was the wrong period. Um, so you can see I have revenues, expenses, common stocks. So there's some contributed capital. Um, since this is only looking at 2024, you see that they're calling retained earnings profit from all prior years. Okay, but that's essentially like the beginning balance of retained earnings. Okay, and then we're adding, of course, the income and expenses from this year, and we would update that and the dividends. Okay, um, you can still see here that it balances, even though I have this mistake. So I must have uh, incorrectly debited accounts payable. Taxes payable. Yeah, I don't know. I got to go back and see what this is. I'm curious, but I'll do that later. Um, yeah, because I didn't take an expense for it. Okay, so I think I know what I did wrong. Okay. Um, this should be actually tax expense because I think what I did was I did debit taxes payable, credit cash, right? Why is that wrong? It should be tax expense, right? So that's, I think, what I did incorrectly. So I have to go back and fix that. Okay. Um, okay. So anyways, so we should be, this is kind of where we ended chapter 3, okay, with this adjusted trial balance. Um, now, when we organize these accounts into a balance sheet, we talked about different ways that you organize your assets, liabilities, and equity. Okay, so the first kind of distinction or way of organizing is current versus long term. Okay, the cutoff point is 1 year. So any asset that you're going to benefit from in the next year or sooner is going to be a current asset. Okay, any liability that you're paying off within a year is also a current liability. Anything that's over a year, either one of those, is going to be long term. Okay, so 1 year is the cutoff. Okay, the other way that we organize our balance sheet is by type. So we'll have our current assets kind of listed together. We'll have our property, plant, and equipment assets listed, investments, intangible assets like goodwill. They'll all be listed kind of in a grouping. Okay, and it's the same thing with the liabilities. And this is to make, again, our balance sheet more readable. The balance sheet is meant to convey information about our business, and so it should be a little organized, right? Uh, it should be presented in a way that's coherent and that will make sense to our financial statement reader, rather than just like randomly listing stuff. Okay, that is like all out of order, not really. There's no method of why the accounts are listed. That's like not going to be as usable. Okay, so this is all in the service of making the financial statement more readable. Okay, and then the next way we organize things is by liquidity. And so you'll see like within current assets are usually listed first. What's the most liquid current asset? Cash, right? So cash is most often going to be listed as the first asset on a balance sheet because the balance sheet will list the assets, it will have the current assets, and then we'll have the most liquid current asset, which is cash. Okay, and then um, it will decrease from there. So it'll usually go accounts receivable, and then inventory, and then other receivables. So it's going to be listed in that kind of order of liquidity. And then the other one is seniority. Okay, so what this means is uh, it relates to especially your liabilities and your equity. Actually, it only really relates to your liabilities and equity. Seniority has to do with if things go bad, who's going to get paid first. Okay, so is it good to be more senior or less senior? What do you think? Okay, and who do you think the more senior, let's say lenders, are earning a higher interest rate or a lower interest rate than the junior ones? Higher? Why? Why would they earn more? What is the rate of return correlated with? Why should you earn more money if you're investing in something? Okay, importance. I like that. Okay, but uh, if you're playing roulette, why do you make more betting on like a single number versus like betting on red, right? I think the payoff for like betting on a single number and getting is like 38 or something. While if you bet on just like red or black, you just get 1 to 1. Why is that? Exactly. It has to do with risk. Okay. So who is taking more risk, the senior lender or the junior lender? Who's taking more risk, senior or junior? If the senior lender is going to get paid first if things go badly, is that less risky or more risky? It's less risky, right? It's like they're getting the first money to come out of the business, right? They're the first people that are going to get paid off. So they're taking the least risk and therefore they're going to make the least return. Okay. The equity holder, the shareholder, is taking the most risk. That's why stocks typically, on average, return more money. But each individual company, there's a lot of bankruptcies that happen too. So on a individual company, you can lose all your money, right? Even though the senior lender to that business may walk away with all their money, right? So the equity holder is going to take the most risk, but they're going to get the most return if things work out. Okay. Yeah. Yeah. So we're going to look at some balance sheets. Yeah. So we'll look at some actual financial statements in a second. Um, even within equity, there is seniority. There is something called preferred stock. Okay. That's a class of stock that's actually more senior than common stock. So maybe let's do this. Let's like list the hierarchy here. Okay. You'll have senior debt. Okay. So this is increasing with seniority. Okay. This is the most secure person in the business. Okay. They're going to be the least likely to take any loss if things go badly. You're going to have, okay. And there's within senior, there's like senior secured. Okay. Where you're a senior lender and you have recourse to some specific thing the company owns, like a piece of real estate. Okay. Uh, some companies just have senior debt. They don't allow the debt holder to say, I got first dibs on this particular thing. Okay, so a lot of corporations um, will just have senior debt that's like kind of secured by everything that the company has jointly. There's like junior debt. Um, there's kind of like quasi debt, like convertible debt, which is more junior, convertible bonds. And you can say also like bank loans. They're going to be also senior here, which are, yeah. So this could be like senior. I'm thinking more of these being bonds. Okay. And then you're going to have preferred stock and then common stock. So let's say the assets of the company were like 100 and the senior debt, let's say, was 60 and then the common stock was 40. Let's say things went bad and you sold everything your company had and you only got 80 bucks. Okay. The first 60 are going to go to pay these guys off. So they're going to get made whole. So that reduces this to 20. And then these guys are only going to recoup half their money. So they take a 50% loss. Okay. So that's kind of how it would work. Yeah. Well, it has to do with how the company's financed, okay? Which is, again, we talked about assets equals liability plus equity. So it really has to do with this side. Yeah, yeah. So it has to, like, people are contributing money to the business, right? They're either going to be lending in the case of liability, or they're going to be the owners of the business, which is equity. And so how the economics of the business gets divided up between those two will be dependent on, you know, if they're lenders, they're going to get a fixed rate of return in interest rate. But if the company does really, really well, they're not going to get any of that benefit, right? They're only going to get a fixed rate of return. We'll see that in a second. Yeah. But I'm just saying, as a concept of seniority, right? This concept that we're calling seniority has to do with the order, the priority of payment of who gets paid off, who's taking the most risk versus the least risk. And yeah, I mean, typically, there's no hard rule against this. This is just a concept that some businesses will list their most senior debt first and then decrease it. And probably like financial bit like a bank, they're gonna have more types of debt, so they'll typically do that. But like Microsoft, they probably have just senior debt, senior bonds. They probably have very little liability. Yeah. But in general, borrowers are taking less risk than the owners. Okay, the owners get to benefit when things go well, but they're also going to pay the cost if things go poorly. Okay, so that's kind of the general split between these two. And again, within these, there's also hierarchy. I guess that was my point of illustrating this. So this is kind of like where it cuts off. This is all liabilities, and this is all equity. Yeah. Okay. Um, Okay, so you can actually convert between these two. Okay, so an example is venture capital. Okay, uh, if you are a venture capital firm, and let's say you invest in some startup, and you're going to put in $20 million. So let's say the company is going to have cash 20 million, and then there's going to have no liabilities. No one's going to lend them anything. Their equity is going to be uh, I'll tell you how it's going to be. It's going to first be preferred stock, 20 million, and then the common stock is going to be technically zero. There's like a way of accounting for this, but just to make this easy, it's zero. Okay. Let's say the company gets acquired. Okay. The owners of the company are going to let's say the company gets acquired for $1 billion. Okay. Um, at the onset, the venture capital firm has negotiated some percent ownership. Okay, let's say they're going to take 20% of the business for that $20 million. Okay, so when they initially make the investment, they're only entitled to get $20 million back. Okay, but what's 20% of a billion? 800 million. Almost 20% of a billion. 200 million. Okay. So would you, as a venture capitalist, rather have 200 million or 20 million, your original money back? What's better? It's obvious. Don't overthink this. You want the 200 million, right? So what they have arranged is that this preferred stock is convertible to common stock. Okay. Because they're only entitled to this 200 million if they are part of this class. So they basically will convert their preferred stock to common stock, and then that will allow them to kind of get this big payday. Okay, let's say things go badly, and uh, you're only offered $5 million. Okay, or 10 million. Let's say the company's like bought out for $10 million. Let's keep it simple. Let's say they're bought out for 20 million. Okay, so the venture capitalist is only negotiated for 20% common stock, right? So what's 20% of 20 million? 4 million. So if they had only originally had common stock, they would have gotten 4 million, and the owner, the entrepreneur, would have gotten 16 million of that 20. Now, does that make sense? Does that seem fair? That they put up 20 million, the company gets bought out for exactly how much they put up, but they're only going to get 4 back. Does that seem fair? Yeah, it's not fair. Okay. And they know that, and the venture capitalists are not stupid. So that's why they have preferred stock initially, because if it's only sold for 20 million, they're going to keep it as preferred stock. They're senior, so they'll get all that 20 million back, and the entrepreneur will get 0. Okay, so they have the optionality to, on the downside, keep their stock senior and get all of the money because they're going to be the most senior shareholder, or if things go really well, they'll convert to common. Okay, that makes sense. It's like a little real life applied example. So if you ever start a startup and you get venture capital, you'll see that they're going to have a different class of stock than you. Okay, they're going to have preferred stock, and you're going to have the common stock. But again, if the company does well, your common stock's going to be worth a lot, and they're going to convert. Okay, okay, okay. So let's just be clear. What is more liquid, real estate or stocks? I talked about this. Let's just make sure we're clear on this concept of liquidity. Who votes that real estate is more liquid? Who votes stocks are more liquid? Yes, you can just go on your phone and sell your shares of stock right away. You'll get your cash instantly. Real estate, you got to list it, you got to find a buyer. It can take months and months and months to convert your real estate asset to cash. Okay. What's more liquid, stocks or bonds? What do you think? Yeah, stocks. Bonds are not ironically, but the way that bonds are traded is mostly over like humans calling each other on the phone, or like DMing each other on Bloomberg. There's like a system that trades are happening. Okay, so you'll have to negotiate with the person to sell like a block of bonds. Okay, and it is still liquid, especially for like U.S. Treasuries. There's a lot of bonds that are very liquid, but it's not as easy to sell as stocks are. Okay, stocks are extremely liquid. Okay, um, so but bonds are much more liquid than real estate, right? So there's a spectrum within liquidity too, and even within bonds, there are some bonds that are not very often traded, and they're illiquid, and they may take days to sell. But typically, uh, it, all bonds are typically even more liquid than real estate, no matter what, because real estate always takes some amount of time. Okay. Um, okay, so let's look at some of these financial statements. I think could be informative. Okay, so we talked about the balance sheet, so let's start with that. Okay, so this is Microsoft. Okay, so you can see that they list their current assets first, and cash is obviously the first one listed. Um, so cash, short-term investments. Okay, short-term investments are like treasury bonds, like short-term treasury bonds. Okay, they're very liquid. It's easy to convert that to cash. Accounts receivable, these are from their customers. A little more difficult. It may take 30 days or 60 days or something to collect these. Inventory, the least liquid of their kind of current assets. And then they have a bunch of other current assets. We'd have to read the financial statement notes to know exactly what that is. And you can see that the total current assets is given. Okay, so next they have property, plant, and equipment. So this is another type of asset that they're listing as a separate line item. Um, Operating lease rights of use assets. What this is exactly, I don't know. We'd have to read. Um, you can see they've kind of put their goodwill and intangible assets at the bottom, towards the bottom, and then their other long-term assets, just like all the random stuff that they own that doesn't fit within these other categories. They have a line item for that. and then they basically just add everything up. Okay, so this is their total assets. Again, a company's main uh, financial statements don't have all the detail. Okay, you have to go look into the notes. Like there will be a note on all their property, plant, and equipment. I think I showed you guys Rivians, right, where it showed you the different types of property, plant, and equipment they had, how much the accumulated depreciation was. So you'll have to find those details if you were curious. It's not going to be, they're not going to give you all the details in this main financial statement. Yeah. Yes, and goodwill too. Yeah, yeah. Unless it's a patent. Yeah, it had to have a valuation of some kind. So yeah, it's probably going to be intangible assets they've purchased. Yeah, so the U.S. government, okay, they have 30-year bonds, meaning these are like 30-year loans that they've taken on. They also have like 3-month or 6-month loans. Okay, they borrow at different terms. So a short-term investment is one that's going to mature. They're usually bonds that mature within a year. Um, like a CD at a bank is also a short-term investment, right? You get some interest for that, and it's pretty liquid. You can just like kind of cancel the CD and like get your money back. So these are all examples of short-term investments. Yeah. Yeah. No, look, these are just guidelines. I think we'll see some other financial statements that are presented differently than this. So there's no like right answer. The goal of these is to make the information useful to the financial statement reader. And every company is going to have their own opinion on what that is, depending on what their business is and just their opinion on what is the best format. So there's no like technically right answer for this. Did someone else have their hand up here? No? Okay. And then you can see, let's look at the liabilities. So again, they list all their current liabilities, so their accounts payable. You can see they don't have any short-term debt. Okay, there's nothing, they have no debt that's due within the next year. Okay, they're gonna have some long-term debt. Let's see, yeah. So they have 40 billion in long-term debt, but it's all like nothing is due within 1 year. Okay, it's all 1 year or greater in maturity. Okay, all their loans. Okay. Um, Actually, no, sorry. So this is short-term borrowing. This is current portion of long-term. Okay, so if they borrowed for 10 years, there's some principal payment, it looks like that's due within 1 year. Okay, so of their long-term debt, some of it is due within 1 year, and they're listing that right here. But they haven't done any like short-term borrowing where they're saying, I'll pay you back in 6 months. That's what this one is. Okay. Um, Accrued compensation, this is probably like stock options that they owe to their employees, um, or bonuses. Um, Unearned revenue, okay, so we know what that is. Probably from subscriptions, or like, let's say you're buying like, they have their cloud service, Azure. If you're like prepaying for a bunch of that, right, it's going to show up here, right? You're buying hours of cloud computing. You're going to pay a bunch up front, and you're going to use it over time. Okay, so that's probably what that is. It's probably subscriptions that they've pre-sold. Okay, and then they have long-term debt, long-term income tax, long-term unearned revenue. So this is, some people are like, I guess, prepaying years of like, more, 2 years of subscription or 3 years, right? So that's going to be long-term unearned revenue. Okay, and then so we have their total liabilities, and of course they probably have a lot of weird stuff going on. We'd have to read. Um, and then it looks like they don't have any preferred stock. They just have one share class, common stock. And chapter 13, we're going to go into like full detail on just this section. But just looking at it, they just have one class of shares, common stock, and then they have retained earnings. Um, and this accumulated other comprehensive loss, that's like foreign exchange gains and losses, and like it's just miscellaneous income. Okay, basically. Okay, so that's Microsoft. Let's look at a bank. Okay, J.P. Morgan. Let me undo that. Okay, what page is this? 172. Okay, so I think it's a little hard, and when I zoom in, it's going to just totally mess up the page number. But again, assets, they have cash. Um, you can see here that they're actually not doing a current versus long term. Okay, they don't have that breakout. They've chosen not to do that. So again, this goes to my point that there is no right answer. Okay, so they have cash uh, due from banks. Okay, so this is not just this is not, they don't have a line item just for cash because they have sources of cash from different places. Okay, so they have cash due from other banks. They have deposits with other banks. So they're both considering these cash or like kind of equivalent to cash. Um, yeah, so their first asset they have listed is this kind of weird uh, conglomeration of different types of investments that are equivalent to cash. Okay. Um, and I guess they're starting off with the ones that are most similar to cash. And some of these are like this is cash and due from banks, meaning that very short term overnight lending to other banks. They consider that as cash. They're grouping that together. Um, they have other types of securities borrowed, trading assets. So they're grouping their first category of assets as just investment securities because that's what a bank kind of does, right? They're taking your deposits and they're investing it in different things. Okay, so in their opinion, grouping all that together into a category is useful for the financial statement user. Um, they have loans that they've given out. You can see this is kind of their largest uh, asset. It's just loans that they have on their balance sheet. And then they have some goodwill and some random miscellaneous stuff. Um, and so if you add all that up, they have, uh, actually, hold on, how are they doing this? So this is investments. Yeah, but this is not the total of all of this. So I think this 681 is only the sum of these two. And then all this other stuff is separate. Okay, so this is I would be a little critical of this. This is like a little hard to read. It's unclear how they've kind of arranged this. Um, but in any case, they have this is a trillion. Okay, 4 trillion in assets. Um, their deposits are 2.4 trillion. So that's all of our accounts and companies. They probably have their accounts with J.P. Morgan. Um, and then they have long-term debt. Okay, so they've borrowed, but really, by far, their largest source of financing is just their people like us who put our money in their with them as deposits. It's by far their largest liability. Um, and then you have equity. So you can see here they have preferred stock listed first, common stock, retained earnings. So it's all here, but they have preferred stock. Okay. So they have that more senior class of stock. Okay, and then Berkshire Hathaway, just to give you one final little comparison. I tried to pick different industries, to give you kind of a look at different formats. Why isn't this working? Okay. So Berkshire Hathaway is a conglomerate. Okay, they own a bunch of different types of businesses. So you can see here that they've done something interesting. They have it arranged by their the type of business, okay? 'Cause since they own so many different ones, they have one for insurance and other, one for railroad, utilities, and energy, and I guess that those are their two big ones, okay? So they basically have two separate balance sheets listed together. So you can see for the railroads, utilities, and energy, they have cash, receivables, property, plant, equipment. And then for here, for their insurance, they also have cash, short-term investments, property, plant, equipment. So they've decided to segment the balance sheet by the types of businesses, and they have two big classes. And if you looked within insurance, they own Geico, they own Berkshire, like their reinsurance business. There's like probably like 20 different insurance companies that they own. And then they own like See's Candy, they own a jewelry store, they own a bunch of different types of other types of businesses. Okay. So that's all going to be combined into this insurance and other. And then they own railroads, utilities, they own an energy company. Um, so this is all going to, they kind of broke that out because in their opinion, it was useful to see these two segments of their business presented separately. And probably their income statement, they're also going to do that. Which one is this? This one? Goodwill is when you acquire another business. And like for the example of like Instagram, right? Their balance sheet was maybe $10 million because they had cash and some computer equipment, right? But uh, Facebook bought them for $1 billion, right? So what accounts for that difference between their assets, which is only 20 million or 10 million, and the $1 billion that they paid for it? When Facebook does that journal entry, they're going to receive assets worth 20 million, let's say. They're giving cash of $1 billion. So how do you fill that gap? And that gap is goodwill. And what goodwill represents is all those intangible assets like Instagram's network, its users, all the extra stuff that's not represented on their balance sheet. It got a value because, that's why it's worth $980 million, right? Because it's only actual assets is only 20 million. So all that extra stuff Facebook said is worth 980 million. So when they do that acquisition accounting, they'll add that goodwill as 980 million. So if you see a company that has a big goodwill balance, it means that they acquire a lot of other businesses. That's probably what that means. Okay. Okay. So I think, yeah, I just wanted to do this to show you the diversity of how these financial statements actually exist in the real world. Okay, we're gonna see it's like kind of contrived in the book, and you're gonna see like the same format pretty much like in the textbook, like for every problem. But there's actually a lot of diversity, and if you spend time reading the financial statements of companies, you're gonna have to like get comfortable with figuring out what things are, because it's not gonna always be like in the same cookie cutter template. Okay. 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 So the accounting cycle. Okay. We've now done most of this. Okay. So before I talk about the chapter 4 topic on this, let's just uh, make sure we're very clear on what we've been doing up till now. Okay. So the first step of the accounting cycle is the start of the period. Okay. So at the start of the period, you're going to have account balances. You're going to have cash. You're going to have your property, plant, and equipment. You're going to have your liabilities. You're going to have all the retained earnings from all the previous periods. Okay, so you're going to have starting balances. And we're going to learn what these are, the permanent accounts. So for permanent accounts, the accounts that don't have balances at the start of your period, revenues, expenses, and dividends, because now we want to start tracking during our accounting period. What were our revenues? What were our expenses? How much did we pay out in dividends? Okay. But so those are going to start at 0 at the start of the period. Okay. Then there's going to be transactions. So during the period, we have all those transactions that occur, right? We're going to buy more property, plant, and equipment assets. So we're going to trade assets for one another. We're going to have revenue. We're going to pay expenses. We're going to have all the different things that happen to our business during the period of time. So the period of time, it could be 3 months, right? If we're reporting our financial statements every quarter. It could be every 1 month if we do monthly financial statements. It could be 12 months if we do yearly. So whatever transactions are happening within this period of time that we care about to measure, we're going to be tracking those. Okay, and we're going to be doing journal entries for those. So that was chapter 2. This is essentially what we did in chapter 2. Journal entries for transactions. Okay? So what we did is we made the journal entry and then we updated the accounts by posting them, right? We had those T accounts. Whenever there was a journal entry, we'd make the journal entry and then update the account balances during the period. And we just kept accumulating those during the period. So now at the end of the period, for like cash, for example, we have a bunch of things that happen. We have debits and credits to cash. We're going to have some balance here, and that's going to be included in our unadjusted trial balance. And we're going to do that for all of our accounts, right? We're going to compile all of our ending balances as of the end of the period and put it into this unadjusted trial balance. Okay. Then what we just did in chapter 3, we know that there are certain things that we need to account for at the end of the period because there's no transaction that's per se happened, right? So we had depreciation as time has gone by. We had prepaid assets like insurance that, again, time has gone by. Interest expense. We had some accruals like salaries payable where the cash is going to be transacted later, right? So we needed to basically do all these adjusting entries to account for all of our deferrals and accruals. Deferrals and accruals. Okay? So this is chapter 3. This is again chapter 3. And we got here. This is chapter 3. Adjusting entries. Okay? So with this adjusted trial balance, we now have our updated balances for all of our accounts. We can then use those balances and convert them into these reports. Right? These are our financial statements. The financial statements are not changing anything in our accounting system. We're taking the information which is presented as debits and credits in our accounting system, and we're taking those numbers and we're putting them into these reports. Okay, again, we looked at these financial statements. There's no mention of debit or credit there, right? We're just those numbers are coming from the accounting system, and the company has arranged them into these reports. Okay, so the information system's output of debits and credits and the balances are used to make these financial statements. Yeah. F, this one? Balance sheet. Yeah. Yeah.
Statement of equity and retained earnings would be the same.
Yeah, I mean, it's in a real company, the retained earnings is just one column in the statement of equity. Because they'll show how much contributed capital came in, what the retained earnings was. They're going to show all the equity accounts together in one statement. They won't just have a separate one for retained earnings. Yeah. And actually, let's see. That might be useful to see, just to be clear. Okay, so oh man, I don't want to zoom out here. Let's see. I think this one is better. Okay, so this is the statement of equity for Berkshire Hathaway. you can see retained earnings is one of the columns. So if you look here, balance as of the previous year. So if we track this balance, it's here. They're going to add net income right here. This is some accounting change. They do not pay a dividend, and so they updated the retained earnings. So it's just one column. They also, if you look at common stock, so this is contributed capital. So they have, this is a starting balance. There is some contributed capital that happened with one of their subsidiaries, and then they updated this. Okay, and then treasury stock. So they do stock buybacks. You can see that uh, they had some stocks that they had repurchased. They did some more repurchasing here, and they're basically updating every part of the equity. Yeah, and of which retained earnings is just one of them. But it's the same process: beginning balance, plus your additions, minus your subtractions, ending balance. Okay, so now we're basically coming to chapter 4. Okay, after we've made our financial statements, we're going to kind of reset the books for the next period. Okay, and what that means is taking the revenue, expense, and dividend accounts and zeroing them out and moving that information into retained earnings. Okay, and we'll see how to do that. It's going to be achieved through these closing entries. These are actual journal entries that will change balances. Okay, again, these financial statements, when we make them, aren't changing any balances. We're just taking the information from our accounting system and compiling a report. When we do these closing entries, we will actually change the balances. We'll make the revenue 0, we'll make the expenses, all those accounts 0, and we'll make the dividend 0. But we can't just zero it out. We got to move that information somewhere. Okay, so we're going to see how that's achieved. And then once that's kind of achieved, we'll have another trial balance called the post-closing trial balance, which is kind of a trivial thing, and you'll probably never see one in real life because it's not really uh, needed for modern accounting software. Um, but basically, all your temporary accounts are now zeroed. Revenues, expenses, dividends are all 0, and you can now restart in the next period and just restart this cycle again. Okay? Okay, so this is the cycle, and the only thing that we're missing now is these closing entries. Okay, this part of it we haven't yet covered. But after chapter 3, you're able to get to this point. You're able to make the financial statements. We've covered all of this already. Okay. Okay. Any questions on this? Yeah. Uh, Public companies must report every quarter. Um, and yeah, and so so like the large companies that we know about, they're all operating on a quarterly basis, and they have a fully audited annual financial statement. Quarterly or like semi-audited, but the annual statement that they do every 12 months, that must be fully audited, and that's really the official financial statement. So they're technically on a 1-year accounting period, but they produce interim quarterly reporting. Yeah.
Will this be on the recording of what?
Which part? This what I've just been doing? Yes, so I'm recording this. Yeah, so you can go back and watch this. Okay. Okay. So uh, I think I've already covered this. So let's just make sure we're clear. What accounts need to be 0 at the start of the new period? Which ones need to carry forward? So who wants to help me with that? Who can explain to me? And I've said it now several times, so now it's just a matter of regurgitating what I've said. So does someone want to help me? Which accounts do we 0 out and why? Yeah. What's your name? Tyler. Yeah. Okay. And why should we 0 them out? I agree with you. You're right. Okay. Does anyone know? Yes, Chris.
Because at the beginning of each period, we start recording our
Exactly. Yes. We want each accounting period to be like a standalone in terms of the income statement. We want to show in the year 2025 what was our revenue, expenses, and how much we paid on dividends. And then in the year 2026, we just want that year. So the starting balance in 26 needs to be 0, right? It's not revenues, expenses, and dividends. We can't keep just accumulating because then we'll only be able to have the income statement for the company from the very first year it existed until the present moment. That's not really useful. We need to have discrete time periods. So we need to basically zero them out at the beginning. Make sense? Yeah. Okay. So, of course, like there are just common sense. Like your cash balance doesn't just zero out from December 31st, 2025 to January 1st, 2026, right? So these are permanent accounts. They're what the company owns, who it owes money to. These are all permanent accounts. They're going to keep. They're actually going to be a running balance. Okay, but revenues, expenses, dividends, they zero out. Okay, so that's really uh, the difference between a temporary account. Again, we have revenues, expenses, dividends, and then our permanent accounts, which are our assets, liabilities, and within equity, okay, contributed capital, right? When I contribute money to my business 10 years ago, that balance is going to it's going to keep rolling forward, okay? The retained earnings is going to get updated. And what we basically do, what this closing process is going to accomplish, is it's going to take at the end of the period all the balances here and transfer them into retained earnings. That's the goal of this. We can't just zero these out, okay? We have to retain that information somewhere. And that information is going to be transferred into retained earnings. Okay, that's what we're going to accomplish with these closing entries. Okay, so let's just very quickly take 5 minutes, go through this. You can take a little break too if you need to go to the bathroom. This should be easy. Okay, you're just going to identify whether these accounts are temporary or permanent. Okay, so take a minute, see if you can do that, and you can take a little break too. Okay. So sorry, I recorded a little late. Here are the answers to these. I'm not going to go through the explanation again, but at least if you're watching the video, here are the answers. Sorry, this is a P, permanent. Okay. Again, the goal of this closing process is to net what we saw here. We have this credit balance. We have this debit balance. The net effect of this is, you can say, a credit balance 600. And this we would have seen in our financial statement. The income statement would have shown a net income of 600. Okay, so and let's just add one more to this. If we paid a dividend, okay, it would have been whatever 300. It would have been a debit balance because dividend is a debit normal. Okay, now we can net this and this together. What are we going to get? 300 credit. Okay, that's the net effect. I've reduced revenues, expenses, dividends into one net effect, which is credit 300. Okay, so that's essentially what we're going to do. Okay, and through a series of journal entries, we're going to move the balances around and get this net effect. Okay, so again, I just described it here. What this bullet point is saying is you're going to take the credit balances of the revenues and the debit balances of the dividends and expenses, net them together. You could have made a loss, right? Or you could have paid out more dividends than you earned in net income. So the net effect, it could be a credit balance or it could be a debit balance. You're going to see what that is based on what happened in your period. Okay? But you're going to figure out what that net effect is, either a debit or a credit. Okay? And then you're going to then update retained earnings with that debit or credit. Okay? And retained earnings, if you've made a profit through the history of your company, do you think that's going to be a credit balance or a debit balance? If you've always made a profit and you've not paid out more dividends than you've earned, what should it be? Credit, yes. Okay? So if you have a credit balance in your starting balance for retained earnings, you've made a profit in your period, you didn't pay out a bunch of dividends, it's going to be a net credit. So it's going to increase your retained earnings. Okay? So we're going to see that play out when we do these closing entries. Okay. One big area of confusion: adjusting entries, closing entries. They're two totally separate things. Adjusting entries are from chapter 3. They're actual economic realities that exist in our business, and we want our financial statements to reflect that, which is why we did those adjusting entries in chapter 3. Closing entries is just a bookkeeping thing. We're just moving balances around. There's no transactions. There's no economic event happening in our business. We're just moving things around. We're moving revenues, expenses, and dividends into retained earnings. Okay, and we'll see how that's done again in a second. Unlike the financial statements, which are just compiling things, these closing entries will actually change our balances, right? It's going to make revenue go to 0. It's going to make all the expense accounts go to 0. It's going to make the dividends go to 0. And whatever the net effect of that, retained earnings is going to change. So after we do these journal entries, it's going to actually change balances in our accounting system. Okay, so make sure you're clear about that. And because of that, order matters. You first get the adjusted trial balance, you make your financial statements, and then you would do these closing entries. Because if you did it the opposite, if you did the closing entries first, your income statement would be, you would have lost that information because you need your revenues, your expenses, and your dividends to make the income statement. Your balance sheet would actually be correct because what we're doing is we're updating retained earnings by incorporating the revenues, expenses, and dividends. So if you did these closing entries first, you would only be able to really produce one financial statement, which is the balance sheet, because your retained earnings would be correct. It would be the ending balance of retained earnings. Okay? Yeah.
So your adjusted interests are not changing in account balances.
Adjusting entries do and closing entries do. They both do. But an adjusting entry, remember, is like if you have salaries payable, right? If you have interest that you're accruing, it's for actual economic realities of your business. The closing entries are just moving the balances around. Yes, both change. Okay, so this diagram, I think, illustrates everything you need to do for closing, doing these closing entries in one shot. Okay, so look, there's 4 journal entries that you need to make. Okay, and they're all numbered and color coded here. The first one is credit revenue, debit this temporary account called income summary. So this first entry is, you can see, debit revenue, credit this. Okay, so let's say this is 100. Okay, so what we're going to do in this first one is debit revenue, 100, credit income summary. I'm just going to call it IS, 100. Okay, so you see here, this is a credit, this is a debit. This is going to now be 0, right? Because I just debited revenue 0. But I did not lose that information. It's now just moved to income summary. I'm going to do the same thing now, but reverse for expenses, because they all have debit balances, and I want them to go to 0. So I'm going to credit each expense by its, so let's say we had salary expense. Let's say it was $1,200. To make this go to 0, I need to credit it 1200, and then I would debit income summary 1200. So again, I've moved this balance to here, to this income summary. Okay, so again, I haven't lost any information. I'm just moving the balances. Okay, so now this income summary has basically in one account my revenue balance and my expense balances in one place. Okay, and then I'm going to figure out what that closing balance is. Okay, I'm going to net all those together. And so if my revenues exceeded my expenses, it's going to be a credit balance. Okay, now income summary needs to get closed. Okay, we're going to close this out because it's just kind of a fake holder account I've created. It's not a real balance. Okay, so I'm going to zero this out. So I'm going to, if in the case I have credit balance here, I will debit income summary, and I'm going to move that balance here to retained earnings. That's where it's going to live. So you can see here that this is a credit. Okay, that means that my revenues were more than my expenses, which is why this ended up being a credit balance. And then when I move that balance using this journal entry, it's also going to be a credit here in retained earnings. Okay, so I've just moved stuff around, I've netted it together, and I've dimensionally reduced what was happening. Okay, and I've put everything into one number. Okay, all my revenues and expenses. And then finally we close dividends. Okay, so we, just like we would have a $1,000, we paid dividends this period. I need to credit dividends, and then I'll debit retained earnings. And so you can see this is essentially my statement of retained earnings. We have a beginning balance. I'm adding my net income, assuming it's positive. We didn't make a loss. And I'm minus my dividends because it's a debit. And I'm getting an ending balance. Okay? So I've kind of represented my financial statements in my accounting system now. This would have been the income statement, and this is the statement of retained earnings. Okay, but now I've actually changed the balances because I'm doing journal entries. Make sense? Okay, so let's do some practice problems. Okay, actually, let's just I'll walk through this one more time. Okay, just so we're clear here. So let's say this is my ending balance. I reported this 3,500 in my income statement. Okay, now I'm done with my period. I've made my financial statements. It's time to close my accounts. My journal entry is going to be debit revenue 3,500, credit income summary 3,500. So, whatever, it's going to be revenue 3,500, income summary 3,500. This is my journal entry. And then I posted it, right? So now I have this 3,500 here, and then this is going to go here. We agree my balance is now 0 for revenue. We're good with that? Yeah? But I haven't lost it. It's still living here. It's just now in a different place. Okay? So now these are my different expense accounts. Okay? And the goal is to get all of them to be 0. Okay, so I already know I'll have to credit this 600, and I'll have to credit this 1,500. Okay, so I'll have, and then, okay, so let's just put in those two credits. So I know I'm going to have income summary. There's going to be some debit, but I have my credits at least to rent expense. There's going to be 1,500 credit and salary expense. Okay, so how should I get this to balance this journal entry? How much should I debit to income summary? 2,100, right? Okay, good. Okay, so I'm going to now post this here. Okay, so now what is my balance in income summary? 1400 what? This? Exactly. Credit. Okay, so make sure you get this right. You got to make sure it's going to be on the right side, right debit or credit balance. Okay, so these are 0 as intended, which I'm happy with, right? Okay, so now I need to close income summary. Okay, so I have this $1,400 balance. I need to debit this 1,400. I need to credit this 1,400. Okay, so again, income summary, debit 1,400, credit to retained earnings. Okay, so now this goes to 0 because it's a fake account. I need to make sure this is 0. It should have no balance because it's not real. It's just a placeholder. Okay, so I'm happy. This is now kind of gone, and I've moved the balance here. Okay, so what is my balance now for retained earnings? 11,900, right? Credit. Okay, so now final one, the fourth journal entry is to close dividends. So I'll need to credit dividends 800 to get this to go to 0 and debit retained earnings. Okay, so again, the journal entry is debit retained earnings 800, credit dividends. Okay, so now what's my ending balance for retained earnings now? Credit 11,100. Okay, and this is the balance that's going to carry forward to the next period. Okay, and I'm happy. My dividends are 0. My expenses, or is it? Expenses are 0. This one, and my revenues are 0. That's my goal for this whole process. All right, make sense? Okay, so now you can practice. Why don't we do the practice problems first, and then I'll show you why you'll never have to do this. Okay, because the accounting software, it's just a running balance. Okay, it's going to have all your information. Well, it can exactly tell you the balance sheet on some random day of the year. So we'll look at that in a second. But let's just practice doing this. So open up the Excel sheet. And let's do 4-19. It's the second tab. Um, okay, so basically, you're given an adjusted trial balance, and you got to just close. You got to do the closing entries. Okay, so you can see there's dividends, there's revenue, and there's a bunch of expense accounts. So you're gonna have to get those to go to 0. So just follow those. This. Maybe I'll copy this diagram, which is all messed up. But let's see. Okay, so I'll put this on the spreadsheet here, and it can help guide you as to what. So there will be 4 journal entries, okay, and they're all again color coded. It's showing you what the debit is, what the credit is, and so you just need to kind of apply this abstract kind of diagram to the specifics of this particular uh, company and their adjusted trial balance. Okay, so go ahead and try that, and then we'll reconvene. Okay, so look, this first one, revenue, debit, credit, income summary. So service revenue, debit, income summary is the name of the account. Okay, so this is the first one. I've just done green where I had again, a debit here, credit here. So just to be clear, okay, I have service revenue. There was, let's just say I had, these two revenues in my period, okay? This is what happened in my period. I generated revenue 2 times and I had this balance. This 16,800 is how much I showed in my income statement. Do we agree? Okay, now it's all done. I've made my financial statements. I now want to close my books and start over for the next period. I know that this balance needs to go to zero. Okay, I need my revenues, my expenses, and dividends. All these need to be zero. So if I had this balance, what do I need to do to get it to go to zero? Debit 16,800. This is exactly what we just did right here. Okay, so now this is zero. I saw a lot of people doing this. If I did that, if I switch these two around, I'm going to just end up doubling my account balance. Okay, so the goal again is to not double it. The goal is to close it to zero. Okay, now you're going to do that for every single one of your expense accounts. Okay, so the same thing here. If we just took this rent expense, whatever, we have, what was the balance? $1,400 debit balance. So maybe we had 1,400, whatever the transactions were, it gave us a balance at the end of the period. Debit balance 1,400. I want this to go to zero. What do I got to do? I have to credit this 1,400. Okay, so that's going to be one of the entries. 1,400 credit to rent expense. Okay, and then I need to do the same thing for all of these. Salary expense, I need to credit 3,600. Okay, and I'm going to go on, so on and so forth, and I'm going to close it all with a debit. Because see, look, this orange, it's a debit to income summary. But I'm going to have to add up all this stuff. So I can just do sum, and it's going to be like, I don't know, however many, 5 different expense accounts. I'll add them all up. That's going to be my second journal entry. And what is that going to achieve? It's going to zero out all of these expense accounts. Because they're all going to get a credit for exactly what the debit amount was. And that's going to zero them out. Dividend, $800 debit balance. Again, I will credit dividends and I will debit retained earnings. That's the fourth one. Sorry, I skipped one. Okay, so now with income summary, let's just make sure we're clear. Okay, so remember, this revenue is part of it, and then it was a credit to income summary. Let's just say these are my only two. It's not true. There's like 3 other ones, but let's just say these are the only ones. I would have debited 5,000 to income summary here. So now I have a balance of 11,800 credit in income summary. Now I want this to also go to zero. So what do I need to do to income summary? What do you think? Should I credit this 11,800? What is that? That's not going to work. No, I need to debit this 11,800. Okay, so 11,000. I'm just going to whatever. It's not the right number, okay, because I haven't included all the expenses. Income summary. and I'm going to credit retained earnings. Okay, and I see that again in my diagram here. Debit, income summary, credit, retained earnings. Now that's only true. It's not always going to be true. Let's say I actually had $20,000 of expenses. Okay, I would have a debit balance in income summary of $3,200. And in that case, I would need to credit income summary, debit retained earnings to close it. My goal is always to get this to go to zero though. So I have to just do whatever it takes to close income summary to zero. And then the opposite to retained earnings. Okay, so in this case, I had a loss. It's going to reduce retained earnings because retained earnings is a credit balance. This loss is going to cause me to debit retained earnings. Okay? So look, we only have 3 minutes left. I suggest you try to finish this at home. I'll maybe revisit it shortly. We'll do another practice problem because I don't know. You got to tell me what you're not understanding. I feel like I like walk through it step by step. So if you're unclear, come with your questions of what you're not understanding. I see some people just not even doing the journal entry right, where they have like just credits or just debits. That you should be well beyond that. If you've been doing the homeworks, you've now done so many journal entries, you should know you have to have a balance. Debits and credits have to balance. You have to have at least 2 accounts. And if you have not figured that out by this point in the class, I can only assume you've been cheating. I can't understand how you don't know how to do a journal entry by now if you've actually been doing your work. Okay? So that's on you. Again, it's a little frustrating because I feel like if you've been doing the work, you should we have to keep building, right? If you haven't figured out that stuff, you're going to now be totally lost because we're just going to be doing journal entries. We're going to be building on what we've learned in these first couple of chapters. So I seriously suggest you go back and you review and you rewatch the lectures and you actually figure it out, or you're going to be lost for this whole class. Okay? Yeah.
For the expenses, you have from summary the summary back out all the expenses is not
You're talking about this one?
Yeah. Like it's 5,000 above it. Does it is there a reason for that?
Are you just talking about this journal entry right here? Well, I mean, you put the debits first, right?
Okay, so
Yeah. So since I'm debiting income summary, I'm going to put it first. Yeah. All right. That's it.